Hello and welcome to Strategic Alternatives, where we uncover new ways to raise capital, drive growth, and create value in an ever-changing world, with insights and outlooks from RBC Capital Markets. I'm John Coles, Global Co-Head of Equity Capital Markets at RBC, and I'll be your host today. I'm joined by Chip Wadsworth, Head of TIMT Equity Capital Markets, Jesse Chassie, Head of Tech Equity Capital Markets, and Kelsey Baumgardner, Vice President in ECM at RBC. In this episode, we're broadcasting from RBC's annual Global TIMT conference, where we've been speaking to industry leaders, innovators, decision makers, investors, and everyone else in the ecosystem helping to shape the dynamic sector and the equity strategies being leveraged to support its growth. So maybe, Jesse, I'll start with you. Anything that you heard that was particularly noteworthy that you think is sort of shaping the environment?
Yeah, sure. In some ways, it's similar to the sentiment that we felt this time last year. Broadly, it feels like both investors and companies are more prone to action. There's a broad, post the election in particular, risk-on sentiment, and you're seeing that in certain asset classes, whether it's the run in crypto, whether it's the run this past few weeks in particular and sort of, unprofitable software. So I think broadly, sentiment is definitely better than it's been at really any other time in the past few years. But last year felt a little bit like a head fake. I think what we saw coming into year end last year was a broadening of the equity rally down cap to sort of some of the beaten down names that hadn't really participated year to date. We also saw a little bit more excitement around a bottoming, in particular in the software environment and enterprise spend and the earnings environment there. It feels very similar this year, but I think the broad expectation from investors is it's not going to be so much of a head fake, and there's some sustainability post this tailwind as we move into a year that's not going to be bogged down by some uncertainty around the election. We're going to finally have a shift in the interest rate environment. A lot of that work has sort of been done and sort of put behind us.
Well, and we always come into this in mid-November with sort of this mentality of investors shopping for their next new idea in the new year. Maybe even more pronounced this year, coming through elections, coming through the macro that we've had. We've obviously got a lot going on around the world still. But Chip, maybe for you, how much of the conversation has been with that mentality, getting through some of these huge events that the market's been waiting for and now looking forward to 25?
Yeah, well, there's no doubt. I mean, first, just looking at the numbers, back to Jesse's point around the buzz that's going on at the conference. This is our largest conference ever, right? Over 1,000 people have shown up this year, and in many ways, it's kind of a continuation of the dialogue we've been having with investors over the course of the last 3 to 6 months. A ton of people at that conference really looking for not just kind of the broader ideas and what they can act on, but to your point, thinking about some of those macro items that we wanted to see boxes getting checked and ultimately free up some opportunities for folks. So definitely having an election out of the way has been really important. And in many ways, if you think about not just who won, but the clarity and the speed at which it was determined, that I think created this upside that Jesse's highlighted. I think saying that, looking into 2025, there are these broader themes around how does this private market that we've seen being extremely active match up with a public market that hasn't quite yet seen the number of IPOs that we all want to see, the number of follow-ons that we think are out there. Once we start to see that moving in the right direction, I think that's gonna really clear the decks for a lot of folks.
I think last year, Jesse, we talked about how there was not a demand problem, but there was a supply problem in the markets. And so we're still, frankly, trying to put supply and demand together, but it seems like we're a lot closer.
Yeah, I agree. Look, we've had, 8 tech IPOs this year on the back of 3 last year, so better, but still a low bar. And I think that trend will absolutely continue into next year, where we'll start to see a normalization of the tech IPO market. Now, some of the things that I think are a little bit different from what folks are expecting is, I don't think you're going to broadly see a lot of the higher profile software IPOs that everyone's been super excited about. Those still feel like a lot of businesses that frankly have the ability, whether it's because of their large cash balances, whether it's because how active the secondary markets have been, their ability to sort of do tenders, they can continue to wait. But from what we've seen, and honestly, this is even just in the past 3 or 4 weeks, We've now got line of sight to 8 IPOs next year that we frankly didn't even have 3 or 4 weeks ago.
That's right, and you layer into it as well, and Kelsey, I'll throw this to you. We just, of course, did a deal to finance M&A, right? And I know that theme has been pervasive all year and sounds like has taken up quite a bit of the airtime today as well. How does M&A drive us in the ECM world?
Yeah, I think one of the things that we've heard really consistently from investors is their desire and willingness to support existing companies, fund M&A or fund strategic initiatives. And long-only investors much prefer to be taken out of the market and brought over the wall for opportunistic primary capital raises where there's a clear use of proceeds or some type of catalyst. I think in the month of October alone, we had at least 3 acquisition-related wall crosses across our desk. And situations that work the best have some sort of established pattern recognition with investors. And what I mean by that is a track record of successfully identifying, financing, and integrating acquisitions. You just pointed out an example of a deal we worked on last month for a small cap SMB software business, going through a bit of a transformation at an inflection point today. We served as exclusive financial advisor and sole bookrunner on the equity financing. We underwent a pretty extensive and hands-on confidential marketing process in order to educate the street not only on the equity narrative, but the acquisition, its strategic rationale, and why it was both strategically and financially accretive. We ultimately saw 100% conversion from the wall cross process, upsized the transaction, which I think importantly underscores the fact that there is indeed appetite for small cap growth stories from institutional investors. You don't need to have $1 billion plus of ARR to raise capital in this environment. And we really did leverage the full RBC platform to deliver a comprehensive set of solutions tailored to our clients' very specific needs. And I think the deal showcases our leadership in advising SMB-focused tech companies and reflects what I'd describe as a really seamless cross-product collaboration to drive exceptional results.
Yeah, it was pretty amazing. Today, we had across us probably 15 or so one-on-one meetings with corporates. At each and every one of those meetings, M&A came up. But more importantly, you think about these bigger trends and these bigger themes. M&A has been stuck. It's been stuck very similarly to the IPO market. And it feels like we're right on that precipice where things are going to start to shift and move. And there are a few things that are important to us. The success of the M&A market will probably beget success in the IPO market, right? Having both of those functioning and functioning well. But then second of all, when you think about how those M&A transactions are going to get financed, there's no doubt the convert market is going to be really important to that. So entities using the convert product as a kind of a war chest to raise capital and go after assets, 2025 it's probably going to be an element to how we think about convert product overall.
Yeah, with the overall volumes in the capital markets period and ECM being up, roughly 50%, I think converts right similar to that 50% increase in volume, certainly more appetite, and we hear more interest from those investors to do just that, to finance M&A, to finance growth, et cetera, and that trend will continue. One of the other dynamics that's interested in your views and whether this comes up throughout the day, we sort of have this thesis that every deal these days is a dual track, right? We talk about M&A sometimes and IPOs as different things, but most of the time, in particular for private equity, they're always deciding, should we go public, should we sell, and oftentimes running those right next to each other. So I guess the question in there is, do you see that trend continuing? We're starting to move into our prognostication part of the program here of how we see 25 rolling out. Do you continue to think that that's the case, that every transaction's a dual track?
I mean, the truth is we've seen more tech companies taken private this year than gone public. So our M&A team has been a little bit busier than us. Hopefully that changes in 2025. But Squarespace and PowerSchool are 2 businesses that we took public less than 3.5 years ago, back in 21, both sold to private equity firms. We advised Advent this year on their $6 billion plus take private of Nuvei, global payments platform. That deal actually just closed last Friday. And so unsurprisingly, we've gotten a lot of questions from corporate and private equity clients around the IPO path, and we're having many more dual track conversations as boards, management teams, existing investors weigh their exit alternatives. It feels like DPI is kind of the word of 2024.
Yeah, as it was the word of 2023 and probably will be for 2025. But it kind of goes back to, there is now a reality to an IPO, right? Getting a business public, it has not been a demand issue, it's a supply issue, but having the conversation around a dual path, you can have a very, very credible discussion with a potential seller around what an IPO can look like versus what an M&A transaction looks like, because those both markets are starting to come together and starting to function.
Well, Jesse, I know you had a big piece out earlier this year trying to dispel one of the common misconceptions in the IPO market regarding size and what scale you actually have to be. I suspect the debate still rages, though, on growth versus profitability versus scale. How do you see that evolving, and what are you hearing from investors?
Yeah, I think, look, first thing to address is this question of how what revenue scale do you need in order to get public in this market? And there's this narrative that's been really strong in the Valley and really has not slowed down even as the market has gotten better, over the past, call it 12 to 24 months, that all of a sudden you need massive scale to get public in the U.S. markets. You need, upwards of $1 billion of revenue. And the reality is, our view is that it's just plain wrong, right? So we did a ton of work and dug in and, looked at things like what's the correlation between revenue scale and valuation across all tech companies? The answer is there's zero. What's the correlation between revenue scale and post-IPO market performance for the 2021 and 2020 IPO cohort? The answer is there's zero. We then scan sort of the universe of small cap investors and just, ask them, like, what are you looking for a company to get public? And the reality is it's nowhere near the $500 to $1 billion that sort of some of the prognosticators are speaking about. I think what those investors are looking for is a substantial enough float and market cap such that there's sort of enough liquidity and not too much technical overhang on the stock that it could trade sort of on fundamentals rather than on technicals. And the reality is that market cap tends to be closer to $1 billion to $1.5 billion, which would sort of imply a revenue base of 100 to 200 million versus 500 million to $1 billion. And so we think that's frankly a misconception in the market. We think that will start to cure itself as there's just more deal activity, which will beget more deal activity and encourage some of the smaller issuers to enter the market. But the answer there is it's just not right.
Yeah, well, and it might also be a leftover of the fact that the IPO calendar, even in tech, has been dominated by private equity activity, right? That has just by definition bigger, a little bit slower growing, certainly more profitable. And what has been missing is the traditional venture capital backed IPO, right? So what are you pivoting in that regard? Is that something we see reinvigorating the IPO markets, the VC?
100%. Now, saying that, the 8 or so IPOs that Jesse has highlighted, they're definitely more angled towards private equity. So those will be the first ones to come. But the venture community, up until now, our view has been the difference between what's happened in the private market and where they raised capital for those private entities versus what could be garnered in the public markets. That delta has been significant enough that it's held a lot of folks back from being public. We think that's starting to thaw. You're starting to see multiples shift up in the software space in particular, which will help. Many of these businesses, their models have improved as well. So you start to put those things together, and that should drive venture moves into the marketplace. Now, saying that, look, our view is this growth versus growth with profitability question, that's got to play itself out. Rule of 40 is really important. There's no doubt about it, and that's going to be a watchword for folks. But the classic growth IPO where there isn't profitability and there isn't profitability for a little while, that's probably going to be, there are going to be a few of those coming out in 2025 because, back to Jesse's point, growth assets, risk on, that mentality is in the marketplace right now. You start bringing a few growth assets into the marketplace, growth IPOs, our sense is those will garner a lot of attention.
Especially because there's a scarcity of growth companies in the tech public markets today. I mean, we have a dashboard of 400 plus public tech companies that we track. About half of them are in software. There's less than 10 that are expected to grow more than 25% next year. 85% of public software companies today are growing less than 20%. And so the IPO market, remains a really important opportunity and avenue for investors to underwrite growth stories that are absent today.
Yeah, I think saying all that, we definitely have to see the buy side come over to that side, right? We have not seen it yet. You kind of go back to Rule of 40. Our analysts just put out free cash flow per share as an important KPI for them. So if you kind of think about it, they're really looking for other areas to measure profitable growth instead of just going down the path of growth at all costs.
Okay, so scale, profitable growth, having a combination of private equity backed and venture capital backed. What sectors do you see being the most active, right? You can't go 5 minutes walking anywhere without hearing AI and AI derivatives, right? But as I hear you all talk, not sure that's leading any IPO market out right now, right? It may be more of the fintech and other traditional sectors. Where are you spending most of your time?
Yeah, there will be some of that. I actually think the more infrastructure picks and shovels assets, and this has sort of changed quite a bit in just the last 6 months. I actually think we'll see some of those IPOs next year, and there will be a lot of demand for those IPOs. I think, look, what everyone expected would reopen this IPO market is software. I actually don't think that's going to happen next year. I think based on the activity and discussions we've been having, there will still be a good bit of sponsor-backed, sort of more moderate growth IPOs. I think there will be quite a few fintech IPOs and a pretty diverse pool across fintech of sort of more the direct-to-consumer and then also the B2B models. And then I think within software in particular, there will be, IPOs, but it'll be skewed towards sort of cyber security and infrastructure just because the earnings environment in those sectors has been much more stable. But again, the big marquee IPOs that the market has really been waiting for still feel like they're 2026 events. That being said, I think there will be a lot more supply and diverse supply, quite frankly, for investors to choose from next year.
Yeah, diversity across sector and diversity across cap.
Yeah, that's right.
And what is the current thought on, again, we're circling back to our time here in being a couple weeks post-election and trying to absorb everything with the new administration. There is some view that the path to IPO, frankly, the path to M&A gets easier in some ways in a more lax regulatory environment. Do we think that is any call to action from some of the owners here who've been waiting in the sidelines, waiting for some of this? Do we think that is the catalyst or one of the catalysts that sparks activity?
I think it's one of the catalysts, but again, it's more like that box has been checked. We know who is in office. We know kind of the mentality that they're going to go after the market. It ultimately goes back to fundamentals, strategic outcome, and quite honestly, the relationships at the level that are making the decisions. Those are going to be the real catalysts to getting things off the ground here going forward.
Yeah, so it's much more than just the M&A environment. I think there's a broad expectation that the economy will be better in a deregulated environment.
But saying all that, we have to watch what the 10-year is doing, right? Because there is definitely this underlying concern that the new administration is going to push things in ways that either the market doesn't understand or it understands and it doesn't necessarily like. And that's why you still see a 10-year with a kind of mid-4 handle on it. And you even see it inch up after the Fed takes rates down. So all of this is super, super positive. But I think the market is telling us, let's be mindful of what the backdrop looks like in the first 6 months of this next year.
Well, and the name of our podcast is Strategic Alternatives, and I think what we're seeing is that there are lots of alternatives out there. One of the ones we haven't talked about that is certainly weaves its way into everything is the private markets. We talk a lot about the fact that the IPO used to be a financing event. Rarely these days is it a financing event in terms of providing growth capital. Companies can get access to all the capital that they need privately, and it does raise the bar a little bit for what do you get in an IPO? What's it for? But maybe, Kelsey, I'll kick it over to you. As you think about the strategic alternatives, how do you see, as you're talking to clients, investors, the private markets finding their way into those discussions?
Yeah, I mean, I think as a team, we're spending a lot more time with private clients and talking through what a potential crossover round would look like. We have a couple of mandates that we're working on right now, and managing expectations in terms of value and narrowing down the investor universe. And so I think that's another reason that we haven't seen the same level of IPO activity. Is there's just a much deeper secondary market for some of our corporate clients to provide liquidity to their existing employees or investors. But we're spending a lot more time in the private market. I think in terms of crossover investors, I think it's a natural place for some of our clients to find a really strong stamp of approval from a large pension fund, a mutual fund complex, sovereign wealth fund, who can support the business 12, 18 months in advance of an IPO, and then maybe even come and participate and be on the cover on the S1. That's one of the major tactics we've seen emerge over the past couple of years is issuers and sponsors finding ways to de-risk transactions. Most recently in tech, we had the Ingram Micro IPO last month. Capital World was on the cover of that for around 18% of the deal. Back in the spring, we worked on the Waystar IPO, which was the first HCIT IPO in 3 years. And they launched with Neuberger Berman and QIA on the cover for about $225 million. And so de-risking continues to be top of mind, accessing the private market, and having conversations with investors, not just during the roadshow, not just during the testing the waters process, but building that dialogue months and years in advance.
Yeah, it's interesting. All of these private situations that we're working through right now, they want to know what the next step and what the connection is to that IPO. The investors that you're talking to, not only are they investors that the market will respect and respond to positively when the business goes public, but to Kelsey's point, will they actually then participate in that transaction? And that is very central to a lot of the decision making and the targeting work that we do during the course of these private exercises. It just goes back to the fact that each one of these steps, they're linked. They're linked in the context of how people make decisions, and they're linked in the context of how entities are valued, and then ultimately how the liquidity is actually created.
Look, many of these companies have actually gotten themselves profitable as private companies. And with that, I think the spectrum of alternatives that you can use to finance yourselves as a private company has really broadened out. And so the conversations sort of from an advisory perspective that we've been having have focused a lot more than in the past around sort of cost of capital and how to think about the spectrum of debt to equity in financing either sort of CapEx cycles, M&A, et cetera. Whereas previously it was like, what does the pre-IPO round look like? That is not where those conversations start these days. It's much more broad from a sort of capital alternatives perspective.
Chip, when we're talking to private equity sponsors, I think we're seeing them be as creative as they have been in a long time with the alternatives that they have, right? Whether it's thinking about margin loans or using derivatives to get out of positions or really everything in the toolbox. What are you seeing there?
This is a theme and a trend that's started years ago with a small group of sponsors where, whether it was DPI or just trying to manage their returns and thinking creatively, we saw a few folks, especially out on the West Coast, working with our team, the SCS team, on, effectively putting into place derivative structures that enhanced their overall investment in a business. What's played out over the course of the last couple of years is the number of sponsors looking at those types of structures and securities, it's ballooned to a significant amount. And then ultimately, the products themselves and the creativity, especially from our team, in what they're able to provide those sponsors as it relates to solutions. And so your question about creativity earlier, it isn't just go into the public market with an IPO and then follow up with a couple follow-ons and or blocks. It's let's think about either doing something pre-IPO, or when we structure the IPO, let's make sure that sponsor has some flexibility on where and how they can monetize those shares. And then once the entity is public, let's really think creatively about putting that into motion. And so we anticipate that playing out on a go-forward basis. And again, it's not just going to be in the context of new issuances. We're starting to see it back on the M&A side in a number of M&A transactions. There's one publicly announced M&A trade that's take about 12 months to close. Sponsor gave us a call to find out specifically what can they do during the course of that period of time between now and close to effectively create the returns to their shareholders or their LPs they're looking for. Margin loan, et cetera. So that theme is not one that's going to go away. And as we think about the stakeholders, it's sponsor-driven right now. I would not be surprised if you see the venture community delve into that a little bit more fully.
Obviously something very important to the way we at RBC run our business as well. There's a reason we have our structured equity solutions business, which includes margin loans, which includes call option overrights and variable prepaid forwards and converts, all within equity capital markets, because it's so important to how owners and companies are thinking about their position. Chip, Jesse, Kelsey, thank you so much for joining the podcast today. This has been hugely informative. You've been listening to Strategic Alternatives, the RBC podcast. This episode was recorded on November 19th, 2024. Listen and subscribe to Strategic Alternatives on Apple Podcasts, Spotify, or wherever you listen to your podcasts. If you enjoy the podcast, please leave us a review and share the podcast with others. Thank you.
This content is based on information available at the time it was recorded and is for informational purposes only. It is not an offer to buy or sell or a solicitation, and no recommendations are implied. It is outside the scope of this communication to consider whether it is suitable for you and your financial objectives.